Welcome to the Explainer. Today, we're doing a full technical deep dive into the critical tax and compensation rules for military members serving in combat zones, zeroing in on the 2026 tax year. So here's our game plan. We're going to start with the big picture pay environment, get into the nitty-gritty of the combat zone tax exclusion, or CZTE, then we'll break down the math on the officer cap, talk about some absolutely critical deadlines, and wrap up with how to turn all this knowledge into a powerful wealth-building strategy. All right, first things first. Before we can even touch the tax rules, we have to talk about the 2026 military pay raise. Think of it as the first domino to fall. It sets everything else we're about to discuss in motion. And this is the number that starts it all, 3.8%. As of January 1st, 2026, that's the across-the-board increase in basic pay for every single service member. And this isn't just a number pulled out of a hat. It's directly tied to the Employment Cost Index, which is how we track labor costs in the private sector. Now, here's why that number is so important. This one pay raise creates a ripple effect that directly impacts the tax benefits for anyone deployed. It's not just about more money in your pocket each month. This increase actually raises the ceiling on how much tax-free income commissioned officers can earn downrange. Okay, so let's get into the core mechanic here. What exactly is this combat zone tax exclusion we keep talking about? Let's break down the rules of the game. At its heart, the CCT is a really powerful benefit that's written directly into federal law. We're talking about Internal Revenue Code Section 112. That's the specific piece of law that gives service members the ability to shield their income from federal taxes while they're serving in a combat zone. And this is where it gets really powerful. It's an all-or-nothing deal called the month of service rule. The way it works is incredibly simple. If you spend even one single minute of one day in a qualifying area, your entire month's worth of eligible pay becomes tax-free. Not just for that day, for the whole month. So, what does it take to qualify? Well, it's actually a bit broader than you might think. Of course, there's active duty in a designated combat zone, but it also covers qualified hazardous duty areas. And here's the really critical part. It also applies to anyone in direct support of those operations, and the proof for that is receiving either hostile fire pay or imminent danger pay. Okay, let's shift gears and get into the most technical part of this whole discussion, and it's a huge one. We're talking about the limitation or the cap that applies only to commissioned officers. The law here is incredibly precise. If you look at IRC Section 112, subsection B, it lays out a very specific formula. The cap isn't just some arbitrary number. It is directly linked to the highest possible enlisted pay rate, which guarantees that it gets adjusted every single year, right alongside the military pay raise. So let's walk through the exact math for 2026. First, you take the highest possible enlisted base pay. That belongs to the senior enlisted advisor to the chairman, the SEAC. For 2026, that's $11,166.90. Then you simply add the standard hostile fire pay amount, which is $225, and that gives us our total. And there it is, $11,391.90. That is the definitive, hard monthly cap for every commissioned officer in 2026. In any given month in a combat zone, any excludable pay you earn above that specific number becomes subject to federal income tax. Now, this is where that cap has some serious teeth. We call it the bonus trap. Just look at this breakdown. An enlisted member gets a $50,000 bonus in a combat zone. It's all tax-free, zero tax. But for a commissioned officer earning $10,000 in basic pay who gets a $30,000 bonus, their monthly income just shot up to $40,000. You subtract the cap, and suddenly, a massive chunk of that bonus, over $28,000, is now taxable income. So, knowing the rules is one thing, but now let's talk about what you actually need to do about it. We're going to cover some urgent deadlines and the compliance side of things for 2026. All right, listen up, because this one is a really big deal and it's time sensitive. We're talking about the Special Leave Accrual, or SLA Cliff. Remember back during the COVID era when a lot of people racked up leave way over the normal limits? Well, that excess leave was protected, or grandfathered in. But that protection has an expiration date, September 30th, 2026. That is a hard deadline. Any of that protected leave over 90 days that isn't used by then is gone, forever. It's a literal use it or lose it situation. Okay, let's talk tax forms. When you get your W-2, you need to find Box 12 and look for code Q. This is where all of that tax-free combat pay is reported. And this is so important to understand. It is not reporting taxable income. It's simply telling the IRS how much of your pay was excluded from taxes. So why should you care about this little code in a box? Because it's the key that unlocks other major financial benefits. For something like the Earned Income Tax Credit, you can actually choose to count your combat pay to potentially get a bigger credit. And for retirement, that Code Q income counts as compensation for IRA eligibility. Think about it. Without this rule, if you deployed for a whole year and had zero taxable income, you'd be completely blocked from contributing to an IRA. Code Q keeps that door open. And now for the fun part. Let's put all this technical knowledge into action and talk about how you can leverage it to make some serious moves for your financial future. This right here is what we call superfunding, and it is an absolute game changer. In a normal year, the 2026 limit for your own TSP contributions is $24,500. But while you're in a combat zone, the IRS lets you contribute all the way up to the Section 415C annual edition limit. For 2026, that is a staggering $72,000. It is an unbelievable opportunity to put your retirement savings into overdrive. Okay, here's another really sophisticated strategy, something called deployment arbitrage. The problem is that many high-ranking officers make too much money to contribute directly to a Roth IRA. But here's the opportunity. Because all that combat pay is excluded from their adjusted gross income, a deployment makes their income on paper look much lower. The result? Their AGI can drop below the income limit, suddenly making them eligible for a full direct Roth IRA contribution. It's an incredible window of opportunity that closes the minute they get back. So let's wrap this all up with this quote, because it really says it all. The key takeaway here is that the 2026 financial landscape requires you to be proactive. These benefits aren't just going to fall into your lap. Whether it's making a plan to use that SLA leave before it vanishes or restructuring your TSP contributions, you have to actively manage your finances to make sure you get the full value of these hard-earned benefits.